Hello, 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 and welcome back to the podcast. Thank you very much for being here. I appreciate it. All right, if you are a first timer, welcome. If you've been here forever, like I just said, I appreciate you. We are going to get into some nitty gritty today because there are a lot. This is what I'm finding. I am on the TikToks. And, you've got Instagram and Facebook and all the others. And there are so many lies. So many lies. It's absolutely insane. People have taken this concept and created noise around it. And those of you that are 100% true to IBC like I am, you have heard Nelson say, there's noise everywhere. And so we have to decipher through the noise. And unfortunately, we have got to the point where we have so much noise around infinite banking that it has become hard for people to know who's telling the truth and who's not. So here I am. I am truly wanting to educate. And so today we are taking time to talk about the loan rates and what happens inside the policy, because there's not a lot of people that are talking about this. I've talked about everything else that I feel I could possibly talk about. Now, if that's not true and you guys can, there's something that I have not discussed and you want that discussed, well, by all means, let's discuss it. But I can talk about IBC and what Nelson is doing, and that's all done. Those are hundreds of episodes ago, right? But let's talk about the inner workings of the policy, because there's not a lot of people talking about this, and so many people are getting bombarded with indexed UL, VUL, all this other junk. So this is what's currently going on in the life insurance world. And I am going to say that all companies work this way. However, I cannot be certain of that because I don't work with all insurance companies. The insurance companies that I work with, this is how they work. So make sure, pull out your contract, read your contract. It's a contract. If you have whole life, it is a contract. So I work with several companies, but two of them do it the same. One of them does it a little bit different. So if you work with a non-direct recognition company, from what I am being told and what I'm seeing with my own non-direct companies, the interest rate that they charge you to borrow money is flexible. It is not a set rate. I work with a company that is direct recognition. That company has a set rate by contract. And so there's no deals in the insurance world, right? For a direct recognition, you're not getting dividends if you borrow the money. Because if the money is borrowed, you're not getting dividends on that amount. Non-direct, you are getting dividends on that amount. So the variable, the interest rate of what they charge you to borrow money can change. Now, this is what I'm seeing. There were companies already in November and December that were changing their interest rates. So I have one company that was a standard 5%. Now, keep in mind, I've been doing this for 13 years, and right after I started, they increased the interest rate, but they have not changed the interest rate since. So I'm going to say 11, 12 years, interest rates have not changed. Now, in these companies that can change rates, they can change it if the Moody's bond rate changes by an average of 0.5%. If that happens, then the insurance company can increase the rate. Now, it takes a lot of work for them to do this, because if you guys don't already know, life insurance companies are archaic. They are 200 years old, some of them. So 100 to 200 years old, depending on the company. that means that they are still using antiquated software, and a lot of what they do is done by hand. And so, as I was told from the companies that I work with, it is a lot of paperwork. Now, one company that I have is changing rates monthly because they can do that if the average Moody's bond is over 0.5%. So, I have one company that changed rates in December, and we went from 5 to, I believe it was 5.75. Then we went back down to 5.5 in January, and then in February, it's going to go back down to 5 because the Moody's bond rate has changed. The average has changed that much. Now, the other company that I work with, they have not changed they didn't change their rates in December, January, they just changed them in February. Now, it even gets more complicated than that. So they can change it, but whatever day your policy renews, that is the day the rate changes. It cannot change until your policy renewal date. So if your policy renewal date was in December, that means that your rate changed in December for the one company, okay, that I work with. So if your policy renewed in December and the rate changed in December, that's the rate for the next policy year. That doesn't change within the year. It changes one time, and that is at renewal date. So whatever the rate is at the day that you renew, that's what it is. If the rate goes back down and it stays down, then next year that will be your new rate. It can be a little bit confusing. And for those of you that are my clients, I had an extensive webinar on this and you got that emailed to you. So listen to it, okay? We went over how loans work. We went over all that stuff. So for those of you that aren't clients, you don't get access to that information from me, but I'm going to try to explain as much of it here as I can. So ask your company. If you are not a client of mine, if you are with a different agent, if you are with a different company, then make sure you are asking how those rates change. When do they change? Do they change? Are they locked in? Is it direct recognition, non-direct recognition? This is something that a lot of us that are in the infinite banking world, we haven't had to deal with this because interest rates have been so low. And so it is always there. Yes, they can change. And I've always said that since day one. They can change. But we've never had to experience it. And so a lot of the agents out there teaching this are learning this along with you, the client, because most people that are teaching the infinite banking concept haven't been in this world more than probably 15 to 18 years. Because remember, Nelson didn't write that book until about 20 years ago, something like that. I don't remember what the exact date is. So make sure that you are looking at your contract. But I want you to understand that that's a locked in rate. Now, some people might say, well, I have a lot of people that are saying, well, it doesn't matter because my loan rate for operating is at 8%. But then there are still other loans that are not higher than that, because right now our loan rate with our companies are at 5 and 5.28. So that is definitely higher than, some rates. Some rates are 6% right now. Some are 5.5. So we're more in line with what's happening at the banks. But we also have bank notes that are at, or operating notes that are at 8, 8.5, 7, though, and they're going up constantly. They don't wait to increase their rates. No. And a lot of people also might say, well, why is the insurance company doing that? Well, this is what was explained to me because I asked the insurance company that question. And this is what they explained to me, is it protects the insurance company from arbitrage. And so if we have a loan rate, let's say we have a loan rate of 4%, everybody could go to their life insurance policies, borrow it at 4%, and then put it in a CD, maybe making 5%, or use it for some other sort of investment. And so all the insurance company is doing is saying, one, I'm going to protect my cash value, so there's no run on the cash value essentially. And two, if you're not using it, why wouldn't you let your own company use it to invest and make more money to then what? Have a bigger dividend. So I would prefer, if I don't know how to manage it, I'll just let the company use that money so that they can make a bigger profit as well at the end of the day. So there's a reason that they do that. They could have been using that money to go make more money. And so you're going to, if it's your business, you're not going to think about it. If you owned a business of lending money, you were the bank down the street. And if you could borrow that money, or I'm sorry, if you could lend that money out and make 6% on it, why wouldn't, and then you came in and used it personally, would you use it for less? No, you probably be like, nope, employees, I'm sorry, but you can't have access to that money for less than 6% because we can go now make 6% off that money. So they are doing some of that as well, which, hey, I'm all for that. All for that. Now, a lot of people in the past have asked me, well, Mary Jo, what happens if interest rates go to 25% and the insurance company will go to 25%? Well, let's just talk about it for a minute. Look back at what Nelson is talking about in his book. When interest rates were 23%, he was borrowing at 5 to 8 from his life insurance companies. So in all reality, is that something that could happen? I don't know. Based on history, I'm going to say no. If they weren't charging him more than 8% when interest rates were 23, why would they do that now? But I can't say that that's going to be for certain. So let's say that they did go to 20%. Would you rather have a loan at 20% that you own and control than a loan at 20% that the bank owns and controls? I would much rather have ownership and control of that loan than having that at the bank where they could call my note and make my life absolutely miserable. We are already seeing it, and I have been seeing it in several states where people are paying off notes and that collateral is not being released. Why isn't that being released? Have banks overlent? And now the feds are coming in and saying, hey, we're going to audit you, and it doesn't look to me like you have enough collateral on the books to cover all of the notes that you have out. We're not lending you any more money. Or is the feds tightening how they're lending? And so now we need to have more collateral to so the feds can lend the banks more money. Because remember, the feds and the banks are two completely different people. But when the bank starts holding collateral, you must ask why. And it's crazy because if you're paying something off, that should just be uncollateralized immediately. There should be no questions asked. And so that is driving a lot of people to say, you know what, I don't want anything to do with the banks anymore. I'm going to start my infinite banking policy, and I'm going to start creating my own banking system. And that it really, really is a big deal. So if rates are higher, I would rather have that higher rate in my policy with my bank, right? Because essentially we're part of the business. We own part of that insurance company. If they make a profit, we get some of that back in the form of a dividend. Now, some of it, if you are being told you get all of that back in the form of a dividend, that is complete hogwash, okay? Complete and utter hogwash. You do not get you pay 4 or 5% to borrow money or 6% to borrow money and you get a 6% dividend. It does not work that way. It is a formula, which I will do a whole nother podcast on, because a lot of people are misunderstanding that as well, or misrepresenting that as well. All right. That's all I'm going to talk about for loans and loan rates. I think I've done another podcast on how loans work and the fact that insurance companies, but they're going to hold the interest in advance. And when you make that loan, they are going to pay the interest back to you and prorate it back to you. So insurance companies you're always prepaying your interest. It is not like the bank where they are going to use it, that you're going to pay it as you go. Right? You are always prepaying, which means it's a lower rate typically with the insurance company because of that. They're going to get their interest. And if let's say that you have a loan and that policy renews for the next year. So we have a $10,000 loan, that policy is renewing. When you get your bill, it's going to say interest due. Interest due means interest for the next 12 months. If you don't pay that out of pocket, the insurance company will grab the cash value and what they need from cash value, and they will hold it. They're not going to take it. They're going to hold it. And then if you pay it back early, they'll prorate it back to principal. That is how my company does it. The one that I work with the majority of the time. Every company might do that a little differently, how they prorate that back, but they should be getting that in advance. Most people don't understand that either. And so the accounting is extremely confusing when it comes to the loan interest because it is essentially calculated per day. And there is not a software out there that I am aware of that calculates it per day. So a lot of the times you have to call the insurance company to get the accounting. If you are a client of ours, we will do that for you. Just reach out to us. But if you want to deduct that interest on taxes, then you are going to need to get the accounting to get the exact amount of interest that you paid for that year. And even then, it's not broke down to the year. Because again, remember, the insurance company is in the business of insurance. They are not in the business of banking. We put them in the business of banking and they are tolerating us. So do not expect all your insurance companies to just drop everything. They are in the business of life insurance. We are using that and asking them to accommodate us. There is no reason that they should even have to do that. So we should all just be super grateful that they do. I do believe, though, that I've done a podcast on that. I would have to look, but you can search my podcast as well. Let me know if you guys have questions on this, comments, whatever. If you are not being told how loans work, if you are not being told interest rates can change on loans, not everything is being disclosed to you. And it is so funny because I have really been kind of beaten up on the bank on become your own bank people on TikTok, and people are commenting that thank you for your honesty, private messaging me. It is alarming to me how much people are seeing of disinformation or people that are answering questions. Apparently, somebody messaged me and said, I've been asking these questions and nobody is willing to answer them. Why? You ask me questions, I'm going to answer it. We're going to probably get off on some tangent and we are going to go down a whole different rabbit hole, but you ask the question and I'm going to answer it. And here's the other thing. If I can't answer a question, because there are still questions I can't answer, right? If I can't answer that question, I'm going to find the answer, but I'm not going to give you some BS answer and hope to God that that's true. I've eaten enough crow in my career that I have not known things and people have misled me to believe things. Or here's a great example. Even with loan rates, I have learned a lot about how loan rates change, and I call the company, but I talk to 3-4 different people at the company because you're going to get one that does not know the answer to the question, but he's going to give you some BS answer. And then I'm out there telling everybody that. Then I talk to somebody else and they're like, no, that's not how it works. So I have a contact at the insurance company that knows those answers because he's been there for 30 some years. So it definitely is not, it's not always the agent's fault, right? We know what I read the contract and I actually was told, here's another example. I was told a specific thing. It was incorrect. I replied back to the insurance company and said, well, that's not what the contract says. And this gentleman replies back and says, yep, that's how it works. And I went into the contract, copied the contract language, put that in an email and said, this is what your contract says. Somebody else replied back and said, Mary Jo, you are right. The other person is wrong. It's in the contract. But then there was another part of the contract that I said, well, you can't do this. And they said, yes, we can. And I said, well, that's in the contract. And they're like, well, that's not how it reads. Because guess what? It's all in legal language and I'm not a lawyer and I'm, very simple. I'm just simple Mary Jo. So make it simple. Don't put all these words. Like, why do you gotta make it so fancy? Maybe make 2 or 3 sentences with an exception instead of making it so legally hard to understand. I hate legal stuff. I hate it because they always make it so difficult. And then you have to go find yourself somebody that can translate it and do it honestly. So anywho, if you have questions, if you have comments, if you have concerns, you know the drill. Email me, MaryJo@WithoutTheBank. If you have not gotten either one of the books, Life Without the Bank or Farming Without the Bank, go to the websites, farmingwithoutthebank.com and grab it there, or go to withoutthebank.com and grab it there. Ultimately, it does not matter what you do and what you're using the money for. The loans are going to work the same. So I'm going to put this on both of my podcasts. So if you have comments, questions, concerns, if you are having a hard time finding somebody that teaches infinite banking and does it holistically to what Nelson was teaching, no universal life, no variable, no indexed crap, straight up whole life, correctly structured to meet your needs. If you're looking for that person, give me a call. Happy to help. At this time, I am booking out to, this is going to release in the next week or so, February. So I'm probably going to be booked out to the end of March because I'm going to be traveling. So my calendar's insane, you guys. So please get your book. And then the second that you get your book, you are going to get a link to my calendar to book your appointment. Book your appointment. If you want to be on the waiting list, email MaryJo@WithoutTheBank and ask to be put on the waiting list. And we have a waiting list. People cancel, people no-show. Have your stuff ready and you could probably get in faster. So let us know that, okay? If you cannot possibly wait, please don't do this. This is what happened. This is what happens when my calendar books out 6 to 8 weeks. People don't want to wait, so then they go see another agent, and that agent has no idea what they're doing. Then they come to me and they're like, oh yeah, I saw this agent from such and such a company, and I'm pretty sure this isn't right, but I did do applications with them. You guys, 6 weeks is not life or death. So if you can hold on, just hold on. I also have a colleague that I have trained, John, and he is able to take appointments too. But if you want to wait for me, please be patient, wait. Don't try to go to somebody that doesn't have a clue what they're doing. It's your finances. Make sure you take them seriously. Okay, let me know if you need anything. Otherwise, have a fantastic rest of your day.